Special features of audit of a non-banking financial company. After studying chapter, you will understand the definition, regulation, types of non-banking financial companies, difference between banks and NBFCs. Gain the knowledge of fraudulent norms, capital requirement, income recognition, provision requirement, loan, the audit procedures and audit checklist of NBFCs. Analyze, apply, and analyze the above mentioned concepts to moderately complex scenarios. Unit overview, definition, registration, regulation, audit procedure, audit checklist, auditor duties, and audit report. CA Sahat is appointed as an statutory auditor of NBFC. How important NBFC is financial systems of the large, diverse country in India. Part of the country's financial services sectors, NBFCs cater to a variety of customers to rural and urban areas. This promoting inclusive growth. Such entities have become the important source of credit for those segments of society which cannot be met strict requirement of the banks for a leading purpose. They are popular in the areas of housing finance, finance of commercial vehicles, microfinance industries, MSME sectors, and other areas. And how does this NBFC differ from the banks? Although NBFCs lead like bank, they cannot accept demand deposits and not part of the payment settlement systems like banks. Apart from the system of NBFC, check that founded entities be strictly regulated. They have obtained certificate of registration to come as a business or non-banking financial institution. There are an RBI guidelines and norms acceptance in the public deposit, capital accuracy, accuracy, risk exposure, and other measures to monitor the financial solvency and reporting. NBFC are subject to regulation norms of asset classification, provision of income certificate recognition as per the direction of RBI. NBFC has the applicability of NDAs also required considering principles of relevant NDAs in the presentation of statement. In fact, the financial statement of NBFC have applicability to NDAs and requirement to be prepared in accordance with the Division 3 of Schedule 3 of the Companies Act. This audit approach of NBFC has been taken into account of such cases. He was also checking the regularity update of NBFC sector as part of understanding. It becomes aware of applicability of scale-based regulations, definition NBFC on the basis of size, activity, perceived riskness in 4 layers: base layer, middle layer, upper layer, and top layer. Whereas the upper layer is composed of NBFC specifically identified by the RBI enhanced regulatory requirement, top layer should ideally remains empty unless the RBI's opinions there is a substantial increase in potential systematic risk from the specified NBFC in the upper layer. Not in the upper layer published by the RBI. He is also trying to confirm certification where the auditee companies in accordance with the regulations. Sensing that there is an increase in responsibility of the auditors of NBFC to view the various RBI direction, he treated his audit approach accordingly. Not only the auditor of NBFC is required to report to shareholders, he is also responsible for making additional report to the board of directors of the company on certain specified matters in accordance with the RBI directions. Introduction. The non-banking financial company sector has evolved considerably in terms of size, operation, technology, sophisticated, and entering into new areas of financial services. The NBFCs are now deeply interacted with the entities of financial sectors at both sides of the balance sheets. Being financial entities, they are exposed to risk arising out of counterparty failure, funding and assets concentration, interest rate movement, and risk returning to the liquidity and solvency. Another financial sector played all at the same time. There is a segment which sectors do not pose any significant risk to the system. Definition of NBFCs. The Reserve Bank of India 1997 defines the non-banking financial companies. Financial institution which is a company. Non-banking institution is a company which has in principle business of receiving deposits of under any schemes arrangement and is under the management or leading under manner which under the banking institution class of company institutions and banks may with the previous approval of central government notified in the official gazette. Non-banking financial institution. Non-banking financial institution carry out the financing activity, but the resources are not directly obtained from the saver asset. Instead, these institutions mobilize the public savings for entering other financial services like investment. All the institutions like financial intermediates when they known as a non-banking financial intermediate. Investment Insurance Family Unit Trust of India, Life Insurance Corporations, General Insurance Corporation. The Further, in order to identify the particular company, non-banking financial company, it will consider both assets and income patterns as evidence from the last audited balance sheet on the company to decide on the principal business. The company may be treated as NBFC when the company financial assets constitute more than 50% of the total asset netted off. Intangible assets are income on the intangible assets, and income from the financial assets constitute more than 50% of the gross income. Company which fulfills both the criteria shall qualify as NBFC and would require to register under NBFC by RBI. Registration and regulation of NBFC under the 45 1A Reserve Bank of India 1934. No non-banking financial company is allowed to commence or actively carry out the business of an NB non-banking financial institution without obtaining certification of registration issued by the Reserve Bank of India. Have a net owned fund of 25 lakhs rupees or other amount, such other amount, not exceeding 100 crore rupees as a bank may be notified by official gazette. Provision of the bank may notify different amount and net owned fund for different categories of non-banking financial company. RBI has notified different amount of net owned fund for different category of NBFC, including rupees 2 crores for certain categories of NBFC. For certain categories of companies currently applied or registered in NBFC, the minimum net cap owned fund required by 10 crores. Previously was 2 crores. Minimum NOF amount net owned fund is higher than depending upon specific NBFC. RBI has prescribed a timeline to meet NOIF amount of 1 crore rupees in the phased manner for certain categories for existing NBFC by 31st of March 2025. However, the NBFCs P2B and NBFC A, NBFC, no public funds and no customer interference and shall continue to 2 crore rupees. Company incorporated under the Companies Act decide of commencing a business of NBFC non-banking financial companies are defined under Section 45 1A of RBI Act. Section 134 shall apply to the Reserve Bank of India in prescribed form along with the necessary documentation of registration. The RBI issues certification of registration after satisfying itself that the condition of enumeration of Section 45 1A of RBI Act 1935 was satisfied. Reserve Bank of India was issued direction to non-banking financial company on acceptance of public deposit, prudent norms like capital adequacy, income recognition, asset classification, provided the bad and doubtful debts, risk exposure norms, and other measures to modify the financial solvency and reporting by NBFC. Directions were also issued to auditors to report non-compliance to RBI Act and the regulations of RBI Board of Directors. RBI has also issued Fair Practice Code to adopting all the NBFC while doing the leading business. The guidance to inter alia covering general principle adequacy disclosure on the items and conditions of loans and also adopting non-coercive recovery method. Types of NBFC compliance and regularity perspective. In terms of NBFC 45 1F, read section 45 1C. The RBI Act 1935 amended 1997 a non-banking financial company is a company registered under the Companies Act 1956 70. Engaged in business of loans and advances, acquisition of shares, stocks and bonds, debentures, securitization by the government and local authorities and other marketable suitors. Securities of this like nature, leasing, hire purchase, insurance business, cheat business, but do not include any institution whose principal businesses of agricultural activities, industrial activities, purchase, sale of any goods. Provide these services as sale and purchase of construction and immovable properties. Non-banking financial institution which is a company has a public company of recovering deposit under the any schemes and arrangement of one lump sum amount an institution by way of contribution of any other manner. Also non-banking financial company, residential non-banking companies. The NBFC mandate to register to RBI and the NBFC registered to RBI categories as follows. The term deposit acceptance otherwise into deposit, non-deposit accepting NBFC. Non-deposit accepting NBFC or the size is systematically important, non-systematically important. NBFC, NDSE, non-systematically important, systematically important, all the kind of activities they conduct. Within the categories of mentioned above, see that kind of activities they conduct, that are different type of NBFC follows. Investment and Credit Company, ICC, Infrastructure Financial Company, IFC, systematically important core investment companies, IIC, NDIC, Infrastructure, debt fund, non-banking financial companies, IFC and NBFCs, non-banking financial companies, microfinancial institution, NBFC, non-banking financial companies, NBFC factors, NBFC, non-corporate financial holding companies, asset finance companies, and investment companies, and loan companies, mortgage guarantee companies. These are the types of NBFC. All type of NBFCs are either deposit takings or non-deposit takings. If they are non-deposit taking ND suffix with the name NBFC ND. Companies exempt from registration under RBI. The companies are no do financial business or are regulated by other regulators or given specific exemption from RBI from regulatory requirement for avoiding dually register. The following NBFC have been exempted from requiring of registering under Section 45(1)(a) of the RBI Act 1934. Subject to certain conditions. Housing Finance Limited regulated under the National Housing Board. Merchant banking companies regulated under Security Exchange Board of India. Stock Exchange regulated by Stock Security Exchange Board of India. Companies engaged in business of stock broking and sub-broking regulated by SEBI. Virtual capital fund companies regulated by SEBI. Nidhi companies, Ministry of Corporate Affairs and Government of India. Insurance companies regulated by Insurance Regulatory Development Authority of India. Chit companies are under Section 2 of the Section B Chit Funds Act 1982. Specified microfinance companies, securitized and reconstruction companies, mutual fund companies, core investment companies, non-banking companies being core investment company. Therefore, the Core Investment Companies Act, Reserve Bank Direction 2016, which are not systematically important core investment company, as defined under the subsequent para. Core investment companies, alternative investment funds, IIF companies. The core investment companies and asset size less than 100 crores, others and those asset size 100 crores and above but not access public fund are exempted from registration with RBI. The pursuant of the annunciation of scale-based regulation SPS scale-based regulation SPR, a revised regulation framework on NBFC 22nd October 2001, the effective of 1st October 2022, RBI has revised different facilities for existing NBFC classification, regulations like capital requirement, government standards, prudence regulation, etc. Bring on four layers that defines based on the size, activity, and perspective of the recognition. There are four layers of NBFC: base layer, NBFC BL, other NBFCs middle layer, NBFC ML, NBFC upper layer, NBFC UL, and last NBFC top layer, NBFC TL. The top layer is identically expected to empty and will be filed by RBC based on required need of detailed NBFC, populating the various level of mentioned below. Base level. The base level of NBFC are small companies and non-deposit linked NBFC below the asset of 1,000 crores. NBFC undertaking the following activities: NBFC peer-to-peer lending platforms, NBFC account aggregator, NBFC operating finance holding company, NBFC non-availing public funds and not having any customer interference. Middle layer. The middle layer consists of all the deposit for taking NBFCs irrespective of the asset size, non-banking NBFC size 1,000 crores and above. NBFC undertaking following activities: standalone primary dealers, infrastructure debt fund, NBFs, non-banking financial companies, core investment companies, housing finance companies, and infrastructure finance companies. Upper layers. Upper layers shall comprise of the NBFC which are specifically identify the Reserve Bank and warrant and enhancing regulatory requirement based upon a set of parameters and scoring methodology providing detailed circulars sent by the OR as QR code given by takeaways. This top 10 eligible NBFC contains asset size shall always receive to the upper layer irrespective of the asset. Top layer shall identify remains empty. These layers get populated with the reserve banks of the opinion that they are subordinationally increase the potential systematic risk from the NBFCs. The upper layer. The NBFC shall move the top layer from the upper layer. Categories of NBFC carrying out specific activity. As per the regulation structure, the NBFC scale based upon well-active based regulation, the following prescription shall apply respective NBFC. NBFC P2B, NBFC AA, NOFHC, NBFCs without public funds and customer interference with always remains in the base layers as a regulatory structure. NBFC, CIC, IFC, HFC. These include middle layers, upper layers, and not in the base layer. In the case of SPD and IDF, NBFCs always remain the middle layers. Remaining NBFC investment and credit banking, microfinance institution, NBFC factors and mortgage guarantees companies could lie in the any layers of regulatory structures depending upon the parameters of scale based on the regulatory framework. The government owned NBFC shall place in the middle layer as the case of, and they will not place in the upper layer for the notice. Reference of NBFC, NBFC, NDSI, NBFC, October. All reference of NBFC shall means NBFC BL, and reference to NBFC D, NBFC ND shall be means NBFC ML, NBFC ML. The case may be, however, the existing NBFC having asset size between 500 crores to 1000 crores, except the necessary features of middle class, also known as NBFC ML. Details circulars can QR code given takeaways. Difference between the banks and NBFCs. NBFC lead making investment, hence these activities are akin to banks. However, there are few difference between two of them. NBFC cannot accept demand deposit. However, some NBFCs can accept term deposits. The NBFC do not form part of the payment and settlement system and cannot issue checks drawn itself. Deposits insurance facility of deposit insurance and credit guarantee corporations. It is not available deposits in NBFCs unlike the cash of the bank. No minimum exposure to priority sectors are required by NBFCs. The prudential norms, the capital requirement, every applicable NBFC is defined in the master direction, non-banking financial companies, and systematically important non-deposit taking companies and deposit taking companies. Reserve Bank Direction 216 shall maintain a minimum capital ratio of Tier 1, Tier 2 capital, which shall not exceed 15% of the aggregate risk-weighted assets on balance sheet and risk-adjusted value of balance sheet items. Tier 1 capital respect of the applicable NBFC other than NBFC, MFI, NBF, IDBF, NBFC. Anytime they are not less than 10% by March 30th, 31, 2017. Applicable NBFC primarily engage in leading against gold jewelry such as loans compressed of 50% more than financial assets and maintain a Tier 1 capital of 12%. However, in the case of non-systematic important non-banking taking companies, Reserve Bank of India 16 net bond fund required to be compliant. The RBI, via the guidelines narrated 22nd October 21, has received the regulatory framework of NBFC based on the scale. There are many changes made depending upon the category of NBFCs, and they are broadly in the areas of NBFC NP classification. Capital requirement, prudential guidelines, specifically NBFC MIL, NBFC UL. The concentration of credit investment sensitive sector exposure, loan to the related parties of KMP and NBFC will address the large exposure framework, internal exposure limit, and strict more broader governance guidance. Explanation. The directional degree of credit risk exposure, percentage of weightage has been assigned in the balance sheet. For example, percentage weighted to a fixed asset is 100%. Cash bank A balance is 0%. However, the value of each asset is required to be multiplied by the relevant risk weighted to arrive the risk adjustment value of asset. Aggregate shall take into the account of reckoning minimum capital ratio. The risk weighted asset shall be calculated in the weighted average and fund items in a detailed hereby. Weighted risk assessment on bound balance sheet items, percentage of risk. Cash and bank balances including fixed deposits and certificate deposit in the bank 0%. Investment approved security 0%. Bond and public secure banks 20%. Fixed deposit certificate deposits and bonds of public financial institution 100%. Shares of all the companies of debentures, bonds, commercial papers, and all the companies unit holders 100%. All the assets compares of PPP and post commercial corporation COD cash and deposit infrastructure projects in the existing year and the commencement of 50%. Current assets, stock in higher 100%, intercorporate loan deposit 100%, loans are advance fully secured against deposit 0%, loan to staff 0%. Other secured loans and deposit advances considered good 100%, bill purchases 100%, other 100%. Fixed asset net of depreciation, asset lease of 100%, promises 100%, furniture 100%, other assets. Income tax deducted at source 100%, advance tax paid 0%, net provision. Interest due on government security 0%, others 100%. Domestic sovereign fund-based claims and central government 0%, direct loan, credit, overdue exposure, and investment in state government security 0. Central government guaranteed claim 0. State government guarantee claim which have not remained in default, which is a default period of not more than 90 days, 20 30%. The state government guarantee claim which have remained default period of 90 days 100%. Income recognition. The income recognition shall be based on the recognized accounting principles. The income including interest, dividend, higher charges, lease rental, or other changes of the NPV shall be recognized only when it is actually realized. Other income recognized before the asset became NPV and regarding unrealized shall be reserved. Asset classification. The asset classification norms have been shall apply to every applicable NBFC except NBFC MFI. Every NBFC shall allow, after taking into account of degree of well-defined credit weakness and extent of dependencies and collateral security protection, classify the lease, hire, purchase, loan advances, and other forms of credit following to standard, substandard, notified asset loss. The class of asset referred to the who shall not be upgraded merely as a result of rescheduling unless satisfy the condition required by the upgradation. Standardization shall means asset is a respect of which no default in repayment of the principals and interest payment of interest probably does not disclose any problem carrying more than risk attached to the business. Substandard asset shall means an asset which is having classified as a non-performing asset for the period of not extended 18 months. In case of NBFC, covered the non-banking financial company, non-systematically important non-deposit taking companies 2016. The period not exceeding 18 months stipulated in the substandard shall not exceed 12 months from the financial year ending 31st March 2018 and thereby the NBFC covered non-banking financial company. Systematically important non-deposit including taking companies and deposit taking companies. Other asset where the terms of agreement regarding interest and principal having negotiated, rescheduled or restructured after the commencement of operation until the expiry of 1 year satisfying performs under the renegotiated, rescheduled and restructured terms. Provided that the classification and structured loans and non-standard substandard assets shall be according to the provision of para 25 of directions. Doubtful assets shall means terms loan. Doubtful assets means shall means term loans, lease assets, hire purchase assets, non-other assets, which remains substandard assets a period of exceeding 18 months. In the case of NBFC covered non-banking financial company, non-systematic and importance of non-deposits taking companies. Direction 2016. The period exceeding 18 months stipulated of substandard shall exceed 12 months on the financial year entered NBFC and thereby NBFC covered non-banking financial companies, systematically important non-banking taking companies and deposit taking companies. Direction 2016. Loss assets shall mean any assets which is being identified as a loss assets is applicable to NBFC for internal and external auditor of the banking during the inspection of application NBFC extend not return of the applicable NBFCs. Asset which is adversely affected by the potential threats and non-recoverability due to the either erosion of the value of securities or non-availability of securities or due to any fraudulent act of omission on the part of borrowers. Non-performing assets (NBA) means the asset respect of which include interest has been remains overdue period of 6 months and more. The terms alone including unpaid interest when the installments overdue for a period of 6 months and more and which interest amount received overdue for a period of 6 months. Demand of call loan which remains overdue for a period of 6 months or more than the date of demand of call which is interest amount remain overdue for a period of 6 months or more. A bill which is remain overdue for a period of 6 months or more. Interest respect of debts or income receivable under the head other current asset in the nature of short-term loans and advances which facilities remain overdue for a period of 6 months or more. Any law dues or account of sales of assets or services or entering a reimbursement of expenses including incurred in the remaining overdue period of 6 months or more. NBFC cover non-banking financial companies, systematically important non-banking, non-deposit taking companies and deposit taking companies. Period of 6 months or more stipulated for subclass A shall be 3 months or more for the financial year entered 31st March 2016. This implies NBFC cover non-banking financial companies, NBFC important non-deposit taking companies. 6 months or more. The lease rental and hire purchase installment which has been overdue for 12 months or more. The non-banking financial companies systematically important non-deposit taking companies and deposit taking companies. Corrections, a period of 12 months or more are stipulated on a substandard shall be clause 3 months or more financial year 31st March 2018. They imply that non-banking financial companies and non-systematic importance, non-deposit taking companies reduction to criteria 12 months only. In respect of loans, advances, and other credit facilities, including bill purchase and discounts, balance outstanding under the credit financials include accrued interest made available to the same borrowers and beneficial when the above credit facility became non-performance asset. Provision that the case leaves a higher purchase transactions and applicable to NBFC shall classify such each an account in basis of the record of recovery. Provision requirement. The provision requirement is given below shall apply to every financial applicable NBFC except NBFC MFI. Every applicable NBFC shall, after taking into account of time lag between the account becoming non-performing and reckoning such realize of the securities and the erosion over time and value of security charged, make a provision against substandard asset, doubtful assets, and loss assets provided here. The provision requirement of respected loans, advances, and other credit facilities, including bill purchase, discounts, RB, loss assets. The entire assets be returned of the assets are permitted to remain in the book for reason 100% of the outstanding shall be provided. Doubtful assets. 100% provision to the extent of which is advance is not covered under the realized value of the security which is applicable to NBFC has and valid resources shall be made. Realizable values to be estimated on the realistic basis. In addition to the items above, depending upon the period of the asset has been remained doubtful, the provision asset is 20%, 50%. The second portion, estimate the realizable value outstanding shall be made the following basis. Period of which asset is being considered to be doubtful, present provision up to 1 year, up to 20%, up to 3 years, 130%, up to more than 3 years, 50%. Substandard asset, a general provision of 10% of total outstanding shall be made. Standard asset performing, every NBFC is covered under the NBFC Act. Every NBFC covered under the NBFC financials are systematically important non-banking taking companies, deposit taking companies shall make provision for standard assets 4.4% of the end of 18th March thereby outstanding which shall be recognized as the arriving NPA. As per the non-banking financial company, non-systematic important, non-deposit taking companies and direction process, every applicable NBFC shall make a provision of standard assets 0.25% in outstanding amount. The provision towards standard assets need not be netted off the gross and advances, but shall be shown separately contingent provisions against standard asset in the balance sheet. The above regulatory requirement to be admitted in the phased manner under the scale of scale-based regulatory prescribed in the RB of NBFC. Student made master circular action NBFC, systematic importance in non-deposit taking companies and master directions of NBFC, systematically important non-deposit taking companies, deposit companies, and detailed guidelines of prudence norms relating to NBFC directions. Audit procedures. The following are the necessary steps involved. Ascertaining the business of the company. The first step carrying out the audit of the NBFC is scan through the memorandum of articles of the company. So the acquire oneself the types of business of the company intended to. Normally, the memorandum of articles of the company would vary wide scope, thereby permitting to undertake the host of business activities. But companies generally to specialize in focus on the few selected activities. Auditors should therefore make careful study of the business policy of the company so to ascertain the principal business activity. For this purpose, auditor may also scan through the minutes of the committee meeting, and discussion to the top level management to ascertain the corporate business plan strategy, which is given him clear pictures of the business objective of the company. Auditor should then independently collaborate in the finding which actual business done by the companies are reflected by the business financial result. The task of ascertaining the principal business activities by the NBFC in the paramount importance since the very classification of the company as per NBFC in the further classification should be depend upon the principal business activity. Based upon the classification of company, it will be required to comply with the provision relating to the limit of acceptance of public deposit as contained in NBFC public financial direction.